Aloha, this is Kurt Nielsen with eMortgage Hawaii, and this is your mortgage market update for April 2nd, 2012. Today I want to go back and review real quickly the HARP 2 program, so I'll give you a quick update. We'll also go through and give you a mortgage market update and where we are forecasting interest rates to go over the next number of weeks. And then finally, I've been asked to revisit this rate versus purchase presentation that I uploaded to YouTube some time ago about why buyers should be buying now and why interest rates are more important than price. So we'll cover these three topics today. Let's start with HARP 2. Remember that HARP 2 now allows unlimited loan-to-value on refinances. So it used to be that the cap was 105%. Now the federal government is going to allow you to refinance any Fannie Mae or Freddie Mac loan no matter how far underwater the loan is. So this might be good for some of your past clients. You know, you can show a little good faith in helping any past client that you might have that is underwater on their loan but hasn't been able to take advantage of today's low rates because they were so far underwater. Remember that the loan must have been originated before May 31st, 2009, so they will have to have had this mortgage for nearly 3 years in order for it to be refinanced through HARP 2. The loan must be owned by Freddie Mac or Fannie Mae. Just have your client call me or your past client call me, and I can look it up on the Fannie Mae or Freddie Mac website. It's a little tricky sometimes, so if they have trouble finding out who owns their loan, they can call me and I can get in and find out who owns a loan. You will not be charged any mortgage insurance, even if you're at 150% loan to value. There is no mortgage insurance as long as your current loan has no mortgage insurance. This is good on all primary, secondary, and investment loans. A lot of people think this is only good for primary, but it is for all residential loans that are upside down. With Freddie Mac, you cannot have any 30-day lates on mortgages in the last 6 months and no more than one in the last 12 months. And Fannie Mae says that you cannot have any 60-day lates in the last 12 months. I'm not sure if they really mean that you can have as many 30-day lates as you want in the last year, but we're going to see as we proceed forward with the first loans. You have to have at least a 620 FICO for primary residences and a 680 on seconds and investment. Now there's a lot of differences between lenders. Some lenders require no FICO, no income verification. And the other problem that we're having, that each lender is acting a little differently. Some will only refinance loans that they are currently servicing. For example, Wells Fargo, they're only going to refinance Wells Fargo service loans. We have other lenders that don't care. They'll refinance anybody's loan. So I think that's the benefit of going through a broker, is that we have multiple sources and we'll place the loan with the appropriate lender. So that's a little update on HARP 2. I think it's the first government program that has really any teeth, because it really is going to help people take advantage of the current low rates, even though they're upside down on their loan. Now remember, for most of these loans, you have to still qualify on income. So, if you've lost a job or your client's lost a job, they're not going to be able to qualify. Okay, let's just give you a quick update on the mortgage market. The manufacturing index came in today and really beat expectations. So it was up a little bit, and the market really reacted positively to that. The S&P hit a 4-year high. That's because of the manufacturing data, and also corporate earnings have been really strong as companies are reporting their 2011 year-end earnings. Negative news, Bernanke came out and said basically that the economy will not be able to sustain any kind of job growth based on the current economic growth. So he's hinting at another QE, quantitative easing program, call it QE3, whatever you want to call it. So it looks like the government's going to step back in and continue to keep rates way low. And again, the market responded positively to that, but he's basically saying that he doesn't see the economy really rebounding enough to sustain any kind of job growth and reduction in unemployment. Also, Europe unemployment has hit a 14-year high, and their manufacturing contracted for the 8th straight month. In the United States, we had durable orders up 1.6, so that was good news. And the week ahead of us this week is really big. We've got unemployment initial claims. The FOMC meeting minutes will be released. Probably talk a little bit more about what Bernanke's seen in the economy. We've got job cuts coming up, so it's a big week. I expect we're going to have mixed news continuing, and so my forecast is that rates are going to stay near the current levels until something really significant happens. Something's got to push us either up or down, one way or another. Interest rates aren't going to go down much more, so I think that we're just waiting for some really strong economic news to start shoving mortgage rates up. So I think they're going to stay at these low levels. They'll bounce around a little bit, but I think they're going to stay at these low levels until we really do see something in the market. Okay, here's a graph that shows the 30-year fixed rates over the last 6 months. Again, you can see that rates declined very nicely up until just a few weeks ago, and we saw a little bit of a bump up in mortgage rates, and then just in the last number of days they started settling back down again. But I kind of think there's a little bit of a trend upwards. And again, if the economic news keeps coming in mixed, we're going to bounce around that 4% level for quite some time. And do remember that my rate today on a 30-year fixed with a 0.5 point origination fee is still at 3.75%. So we're still quite a bit lower than the national average, and my guess is this is a lot of profit taking going on here by the banks. Without mortgage brokers, they are certainly earning or without as many mortgage brokers as there used to be, they're certainly earning a lot more windfall profit. Here's your rates for today. Again, the 30-year fixed at 3.75, the 15-year fixed at 3 1/8, and the 7 and the 5-year ARM keep hovering under 3% at 2.875 and 2.5%. Jumbo rates creeped up a little bit, but they're still at almost conforming rates. 4.375 on the 30-year fixed, 3.5 on the 15. And look at these ARMs; they're just about the same as conforming rates. So again, the rates are outstanding. They remain to be almost at the historic low, and I think that's good information for you to get out to your clients. So let's talk about those clients that are sort of sitting on the fence. Should they buy now or hope that real estate prices drop any further? And these are really the fence setters. How do you push those clients off the fence? And we've been talking about this, for quite a while. At some point in time, interest rates are going to go up. The market is starting to stabilize. So this is information that you can provide to your client. And frankly, right now, when you're buying real estate with borrowed money, right now the interest rate is just as important, or even maybe more important, than the price you're paying for the property. For the U.S. real estate market, and especially in the Hawaiian real estate market, waiting for a lower home price will likely cost the buyer significantly more over the life of the loan if mortgage rates increase. And mortgage rates will start increasing at some point. So, when should the buyer buy? Again, we've already hit the bottom. We hit the bottom on February 2nd, 2012, and rates have creeped up a little bit since then. So we know we're past the historic low, and it would take a lot to get the interest rates back down to those historic lows. So this is again, back to that graph for the last 6 months, showing you where interest rates, they have been dropping, and now they're beginning to creep up a little bit. This is a graph showing the last 3 years of mortgage rates, and just 12 months ago, we had, our interest rates were about 5.0%. That was just 12 months ago, and you can see they've dipped down quite nicely. But to get back to 5% wouldn't take much, and just a few years ago, we used to think that 6 1/4 was a very, very low rate, and historically rates are typically above 6.25%. So if a buyer begins to see interest rates around the 5%, 5.5%, 6%, we're going to take a look at how that will impact their buying power and their mortgage payment. So let's take a loan scenario. This is John Smith. He has an annual income of $75,000 a year, or $62.50 per month. Currently has a car payment of $350 a month and some credit cards of only about $175 per month in payments. So he has total other debt payments of $525. Now remember that the maximum debt to income can only be 45% for Fannie Mae and Freddie Mac loans, and other non-conforming lenders are also at 45%. So the maximum monthly debt that John Smith's family can take on is $2,812.50 a month. If you subtract out his current car payment and credit card payments, that leaves for housing only $2,287.50. So if we assume property taxes and insurance of roughly $425 a month, that means that his family can only afford a principal and interest payment of $1,862.50. So at today's interest rate, that's approximately a $400,000 loan. So that's the maximum buying power that the John Smith family has at today's current interest rate. So let's assume that the Smiths have a 20% down payment. That would mean that they could afford to purchase a $500,000 home, putting $100,000 down. Okay, so let's take a look at how interest rates are going to impact the buying power and the monthly payment. So in today's current market rate of 3.75%, his monthly payment would be $2,277 a month. And if interest rates just got back up to where they were 12 months ago, to 5%, the payment would jump up to $2,572. That's an increase of $294 a month. Now, if he had higher income, he would just have to pay that extra payment. But in this case, he can't afford that payment because of the debt to income. So at 5% interest, he'd only be able to afford a loan of $345,000. So this slide kind of shows that again, is again at 3.75%, his debt to income is just under 45%. If it went to 5%, he'd be over the maximum of 45%. He'd be at like 49.6%. So in order to get back down to the proper debt to income ratios, he would have to lower his loan amount to $345,000, and that'd get him back down below that 45% debt to income. Okay, so that gives you a good example of the reduced buying power due to just a 1.25% increase in interest rates, which could happen in a very quick time. So again, here's this scenario one at 3.75% with a monthly housing payment at $2,277. If interest rates went to 5%, he'd jump up to $2,572, which means he would have to lower the purchase price, either pay the $294 a month extra if he could afford it, if his income would allow, and that means he'd pay $106,000 more over the life of the loan just with that small increase in interest rates. Otherwise, he would have to reduce the purchase price if he doesn't have the income to qualify, and that's a 14% reduction in purchase price. So with a slight increase in interest rates, this client would have to reduce the purchase price by 14% in order to meet the same debt to income ratio. And I think we're all pretty comfortable that real estate prices are not going to drop down any 14% over the near term. So in this case, it would just simply reduce the amount of house that the client could buy. So just a quick summary, if you look at Oahu's average home price, it dropped only 0.7% from 2010 to 2011. So again, a 14% drop in housing prices, most likely will not happen unless there's another big disaster. The outer islands were dropping somewhere around 3 to 4% per annum, and it does look like home prices are beginning to stabilize, statewide. So, those buyers who are still on the fence waiting for lower home prices, I think the risk of higher interest rates is obviously, I think, much more plausible and much higher risk. Again, as I said, mortgage rates could easily rise to 5% or more in a very, very short time. We've seen it happen in a 90-day period of time. So a rise in the interest rate from current rate today of 3.75 to 5% would reduce the buying power of a homeowner by 14%. And just imagine if interest rates went to 6%. That would reduce the buying power of that same family 23%. That's a significant drop in the amount of home that they would be buying. So I hope that gives you, an example of what we would look at, from a buyer's point of view of the, again, the benefit of waiting for lower home prices versus the risk of higher rates. And I think you can see that there is less probability that home prices are going to drop significantly and a much higher probability of us seeing higher interest rates. So I think that ought to be something you can share with your client and give them reason to really step into the market and take advantage of these ultra low interest rates. Again, if you're interested in my mortgage calculator, go to your app store for your smartphone. It's either good on the Android, the iPhone, or the BlackBerry, and then just type in the word loan apps, LOANAPPS, and it should come up with my loan application. You can download it and then just activate it using my cell phone number with no dashes, 808-896-6800. So again, have a good week, and if you have any clients that would like to discuss loan options, I'll be happy to meet with them in person or by phone. I'm at 808-334-6201, and I do answer my phone 7 days a week, so don't hesitate to call over the weekend.